In 2025, stock market investors face unprecedented challenges, including elevated interest rates and overvalued stocks. Warren Buffett's insights provide valuable guidance for adapting investment strategies amidst these turbulent economic conditions. The investment landscape in 2025 is shaped by several formidable challenges. Investors are grappling with high interest rates, stock market overvaluation, and rampant speculation. Each of these factors contributes to a complex environment, making it difficult to identify attractive investment opportunities. Understanding these challenges is crucial for making informed decisions. Given these factors, a thoughtful approach to investing is crucial. I found the Interactive Brokers platform to be a valuable resource. You can find it linked below. Go ahead and check it out. Understanding persistent inflation and interest rates. Persistent inflation remains a critical concern for investors. As inflation rates rise, central banks are compelled to adjust interest rates accordingly. In 2025, the Federal Reserve's actions will continue to influence the market significantly. Elevated interest rates typically lead to reduced spending and investment, further complicating the economic recovery process. Investors must be vigilant about how inflation impacts various asset classes. For instance, high inflation erodes purchasing power, which can affect consumer spending and corporate earnings. This dynamic creates a challenging environment for equities, as companies may struggle to maintain profit margins amidst rising costs. Buffett's shift to bonds, a strategic move. Warren Buffett's recent pivot towards bonds signals a strategic response to current market conditions. By reallocating funds from equities to bonds, Buffett is prioritizing capital preservation. This move reflects a broader trend among investors who are seeking stability in an unpredictable market. Bonds, particularly government securities, are perceived as safer investments during periods of high volatility. Buffett's approach underscores the importance of adapting investment strategies based on prevailing economic conditions. As interest rates rise, the yields on bonds become more attractive, prompting a reassessment of traditional equity investments. Analyzing stock market overvaluation. The current stock market is characterized by significant overvaluation, particularly among large-cap tech companies. Many investors are drawn to these stocks, driven by the belief in their long-term growth potential. However, elevated price-to-earnings ratios raise questions about sustainability and risk. Buffett has pointed out that the market's enthusiasm for a select group of companies has led to inflated valuations. This situation leaves little room for error, as any negative news can trigger sharp declines. Investors must exercise caution and conduct thorough analyses before committing capital to these overvalued stocks. Evaluate the fundamentals. Assess the financial health and growth prospects of companies. Consider alternative investments. Explore sectors or regions that may offer better value. Stay informed, monitor economic indicators and market trends to make timely decisions. Given the challenges in the domestic market, looking beyond borders can be a prudent strategy. International investments may offer opportunities that are overlooked by many investors focused solely on the U.S. market. Emerging markets, in particular, can provide exposure to high-growth sectors at more reasonable valuations. Buffett's investment in Japanese trading houses exemplifies this approach. By diversifying geographically, investors can mitigate risks associated with specific markets. However, it is essential to remain within your circle of competence, ensuring that you understand the companies and markets you are investing in. I've been using Interactive Brokers for my own investments, and I've found their platform to be quite helpful. The link is in the first link of the video description if you're interested in exploring further. Research international markets. Identify regions with strong economic growth and favorable valuations. Understand currency risks. Be aware of how exchange rate fluctuations can impact returns. Diversify wisely. Balance international investments with domestic holdings to manage risk. In recent years, the stock market has increasingly resembled a casino, with speculative trading becoming commonplace. Many investors are drawn to the excitement of day trading and option strategies, often overlooking the fundamental principles of investing. This speculative behavior can create bubbles that eventually burst, leading to significant losses. Buffett warns against treating the stock market like a gambling venue. Instead, he advocates for a disciplined approach focused on long-term value investing. By avoiding impulsive decisions driven by market hype, investors can position themselves for sustainable success. Focus on fundamentals. Prioritize companies with strong financials and growth potential. Maintain a long-term perspective. Avoid short-term speculation and stay committed to your investment strategy. Learn from history. Recognize patterns in market behavior to inform future decisions. Identifying investing opportunities in 2025. Despite the challenges posed by high interest rates and overvaluation, there are still avenues to explore. Investors must adopt a proactive approach to uncover potential prospects. One effective strategy is to look for sectors that are undervalued or overlooked. This could include industries that are not currently in the spotlight but have solid fundamentals. For example, sectors like renewable energy or healthcare may offer promising investments that are not yet inflated by speculation. Focus on fundamentals. Look for companies with strong balance sheets, consistent earnings, and sustainable business models. Explore emerging markets. Consider investments in countries with high growth potential where valuations are more reasonable. Seek out innovation. Identify companies that are at the forefront of technological advancements, as they may provide significant growth opportunities. Buffett's investment philosophy, patience and strategy. Warren Buffett's investment philosophy is rooted in patience and strategic thinking. He often emphasizes the importance of waiting for the right opportunity rather than rushing into investments. This approach is particularly relevant in today's volatile market, where impulsive decisions can lead to significant losses. Buffett advocates for a long-term perspective, reminding investors that successful investing is not about timing the market, but rather about time in the market. By holding on to quality investments through market fluctuations, investors can benefit from compounding returns over time. Maintain a long-term focus. Resist the temptation to react to short-term market movements. Invest in quality. Prioritize companies with a proven track record of success and strong competitive advantages. Be prepared to hold. Understand that some investments may take years to realize their full potential. The importance of avoiding speculation. Avoiding speculation is crucial for long-term investment success. Speculative trading may yield short-term gains, but it often leads to increased risk and volatility. Buffett warns against the dangers of treating the stock market like a casino, where emotional decisions can drive irrational behavior. Instead, investors should focus on building a portfolio based on sound analysis and fundamental principles. This approach helps to mitigate risk and fosters a more disciplined investment strategy. Stick to your strategy. Develop a clear investment plan and adhere to it, regardless of market noise. Conduct thorough research. Base your investment decisions on comprehensive analysis rather than market trends or tips. Embrace a margin of safety. Invest with a cushion to protect against unforeseen market shifts. Learning from Buffett, the punch card analogy. Buffett's punch card analogy serves as a powerful reminder of the importance of selective investing. Imagine you have a punch card with only 20 slots. Each time you buy a stock, you punch a hole in the card. Once you've used all your punches, you can no longer make any investments. This analogy highlights the significance of making each investment count. It encourages investors to be discerning and to focus on high-quality opportunities rather than frequent trading. By adopting this mindset, investors can avoid the pitfalls of overtrading and speculative behavior. Be selective. Treat each investment as a significant decision, investing only when the opportunity is compelling. Value quality over quantity. Prioritize fewer, well-researched investments that align with your long-term goals. Reflect on past decisions. Learn from both successful and unsuccessful investments to refine your strategy. Adapting to market conditions will be essential for successful investing. The landscape may be challenging, but by following Buffett's principles of patience, strategy, and discipline, investors can navigate these turbulent waters with confidence. It's important to remain vigilant and informed, continuously assessing the economic environment and adjusting strategies accordingly. Commit to continuous learning. Invest in your financial education to make informed decisions. I've been exploring investment options, and Interactive Brokers has been a valuable resource for me. You can find the link to their platform in the first link of the video description if you're interested in learning more.